A financial time bomb has started ticking in Washington. But this time, the trigger isn't a missile test in the Pacific or a cyber attack on critical infrastructure. It's not the usual suspects, war games or espionage. No, the danger is far quieter. Far more dangerous. It's in the bond market. In just 72 hours, Treasury yields didn't just climb. They surged past 4.5%, ripping through markets like a silent explosion. Global buyers, longtime pillars of U.S. debt stability, simply didn't show up. Foreign participation in recent auctions fell off a cliff. Trading desks from Wall Street to Singapore lit up with red screens. Traders whispering one word: contagion. Then, with no warning, no announcement, no explanation, the White House folded. China tariffs, once a cornerstone of U.S. trade policy, evaporated. No press conference, no bilateral talks, just a quiet rollback buried in the fine print of an Office of the U.S. Trade Representative release. Entire categories, electronics, industrial machinery, electric vehicle components, were stripped of tariffs overnight. To the public, it was spun as inflation relief. But inside the halls of power, it reeked of panic. Because the administration wasn't just reacting to market moves, it was responding to a threat. Not a military one, a monetary one. According to sources close to the situation, Beijing had begun preparing something far more dangerous than sanctions or retaliatory tariffs: a full-scale dump of U.S. Treasuries. To understand how serious that is, consider the leverage. As of March, China held $775 billion in U.S. debt, already down more than 30% from its 2018 peak. But Beijing doesn't need to sell it all to shake the system. It only needs to signal that it might. As Barclays strategist A.J. Rajadiyaka put it, the weapon isn't the sale, it's the threat. And right now, the finger is on the trigger. This wasn't just a market correction. It was a coordinated warning shot, a global financial repricing, and the U.S. blinked. Behind the scenes, the desperation was clear. Treasury Secretary Scott Bessent, in a rare breach of protocol, reportedly convened a direct emergency call with Chinese diplomatic officials. The timing? Hours before the tariff rollback. Coincidence? Unlikely. According to J.P. Morgan's Phoebe White, the administration didn't just lose control of the bond narrative, it surrendered it entirely. What markets saw was not strategy, it was surrender. But even as Washington scrambled, China wasn't the only player shifting the chessboard. Japan moved first. In February 2025 alone, Tokyo unloaded $36.6 billion in U.S. Treasuries, the largest single-month sale in more than a decade. This wasn't about geopolitics. It was self-preservation. The Bank of Japan had just abandoned its long-standing policy of yield curve control, sparking volatility in domestic debt markets. Japanese institutions, trying to stabilize their own house and defend a rapidly weakening yen, sold U.S. assets en masse. It sent shockwaves across global finance. Because if Japan, America's closest economic ally, was bailing, what would stop China from doing the same? If allies were exiting, what should the market read into Beijing's silence? By March, China's holdings had slipped below $800 billion for the first time in years. That number alone was alarming. But the more terrifying fact? They hadn't even started selling. The message was clear. They could, at any moment. And that was enough to shatter market confidence. Meanwhile, the 10-year Treasury yield, long the bedrock of global finance, edged dangerously close to 5%. It briefly touched 4.96% on March 27th. That decimal point set off a cascade. Mortgage rates spiked past 7.8%, freezing the housing market. Corporate debt spreads widened by 52 basis points in a single trading session. Regional banks, already wobbling, saw their equities plunge 6.2% overnight. According to Goldman Sachs, the Financial Conditions Index hadn't seen a stress spike like that since the mini-banking crisis of 2023. But the problem isn't just investor nerves, it's math. The United States now carries over $36.2 trillion in federal debt. At these rates, each percentage point in yield adds $346 billion in annual interest payments. That's more than the budgets of multiple federal departments, combined. The Congressional Budget Office now projects that interest payments on debt will surpass total defense spending by mid-2025. Just in the first quarter, the U.S. spent $273 billion on debt servicing, more than it spent on Medicaid. And the Fed, paralyzed, cornered. BlackRock's internal client notes, never meant for public release, warned that if yields breach 5%, the Fed may have to intervene outside of schedule. That means emergency buying. That means liquidity injections. That means uncharted territory. But intervention comes at a price. The Fed's own balance sheet is already bloated to $7.4 trillion, and for the first time it's bleeding. In Q1, the central bank posted an operational loss of $142 billion. Because the interest it pays on reserves and reverse repos now exceeds its income from assets. This isn't monetary policy anymore. It's crisis management. Former Treasury official Stephen Ratner didn't mince words. Speaking to Bloomberg, he said, "The Fed is now backstopping both the banking system and the US government. That's not monetary policy, that's triage. And markets can smell the blood." Because the real question isn't can the Fed act, it's will markets trust it when it does? Confidence is currency, and Washington is running out of it. Capital doesn't wait for permission. It moves to safety, and it already is. In Q1 2025, inflows into German bonds surged to 76 billion, a 41% increase year over year. Not because they offered better returns, but because they offered something Treasuries no longer could: credibility. While America drowns in political gridlock, while Japan fights to prop up its currency, while China loads a financial weapon it may never need to fire, Europe quietly offers the last thing global capital is looking for: trust. And in today's world, that may be more valuable than yield. The foundations are shifting beneath the global economy. Eurozone bonds, especially Germany's, have emerged not just as safe bets, but as symbols of something the dollar can no longer guarantee: stability. Since January, the dollar index has slipped 3.8%, now trailing by over 8%. And in boardrooms from Sao Paulo to Abu Dhabi, central banks are recalibrating. They're raising euro and yuan reserves, trimming their exposure to the greenback. By March, the IMF confirmed it. Global dollar reserves had plunged to 57.1% of allocated holdings. That's the lowest point in nearly 3 decades. And then came the words from HSBC's Max Kure, words that echoed like a warning. The dollar is no longer the automatic safe haven in crisis. It's now a volatility amplifier. Meanwhile, China isn't waiting. It's building, quietly, relentlessly, an alternative. Through SIPs, digital yuan settlements, and bilateral energy deals, Beijing is carving out a parallel financial system, transaction by transaction. The great decoupling isn't hypothetical. It's already happening. The White House may have hoped April's tariff reversals would go unnoticed. But Apple's exemption didn't just stand out. It told a deeper story. While hundreds of US firms scrambled to realign their supply chains, Apple moved with surgical precision. It secured waivers for Chinese-made display modules and advanced semiconductor packaging, components critical to its upcoming iPhone 17 launch. Behind the scenes, the realignment wasn't happening. It was being avoided. According to Bloomberg, over 60% of Apple's global assembly still flows through China. 95% of its silicon packaging remains locked in Jiangsu and Guangdong. Tim Cook's February visit to Beijing? That wasn't diplomacy. That was a negotiation. Insiders told Kaikshan he came armed with leverage, warning US policymakers. A forced decoupling could cost Apple up to $21 billion and derail its entire 2025 product cycle. Analyst Ming-Chi Kuo laid it bare. Apple's dependency on Chinese tech isn't just deep, it's embedded into their infrastructure. The exemption wasn't generosity. It was an admission. Some American icons are now too entangled to unplug. Strip away the slogans, and a bleaker reality surfaces, one close to home. According to the Federal Reserve's March data, 37% of Americans can't cover a $400 emergency without borrowing or liquidating assets. And when tariffs were last raised on Chinese imports in 2018 to 2019, the Tax Foundation pegged the annual consumer cost at $831. That was before 2024's inflation spiral, before real wages shrank 1.3% while consumer prices surged 3.7%. That double hit wiped out whatever savings the pandemic had left behind. And now, if full tariffs return, electronics, textiles, auto parts, prices on those goods could jump an average of 12.4%. Americans are already cutting back. Bankrate's 2025 survey says 61% of consumers have slashed discretionary spending. Trade wars may aim at China, but it's the American wallet that bleeds first. This time there's even less padding. Coherence? That's gone. In just 6 weeks, the administration proposed new tariffs on Chinese EVs, rolled back levies on industrial components, and then, almost theatrically, turned around to criticize Apple for doing exactly what it was just permitted to do. A leaked Commerce Department memo, seen by Reuters on March 29th, revealed internal fractures. One camp, led by senior USTR officials, is pushing for aggressive tech decoupling. The other, backed by Treasury and Fed voices, warns this path could rattle markets already teetering under fiscal strain and geopolitical fog. This isn't strategy, it's reaction. It's improvisation masquerading as policy, and markets see it. Allies see it. Cornell economist Eswar Prasad didn't sugarcoat it. Tariffs have become reactive levers, not part of a coordinated strategy. When policy looks like whiplash, confidence evaporates. And so do alliances. Meanwhile, politics grinds forward. Trump's approval among independents has dropped to 39%, the lowest since his return to office, according to April's YouGov poll. And now, the Conference Board's leading index has fallen for the 14th straight month, pointing to a 50% plus chance of recession in the back half of 2025. Goldman Sachs just slashed its Q3 GDP forecast to 1.2%, citing eroded investment and trade uncertainty. In Wisconsin, Pennsylvania, Michigan, layoffs are already underway. Auto jobs are the first to go, buckling under raw material cost spikes as tariff threats hang in the air like a storm. Trump's 2024 campaign rode on a wave of economic strength. But if tariffs now trigger contraction, the backlash could redraw the political map, just as it did in 2008. Sources tell the Wall Street Journal the administration is weighing more rollbacks. But the question is no longer if Trump blinks. It's whether the markets can afford to wait that long. Tariffs can be softened. Auctions can be stalled. Pressure can be applied to the Fed. But none of it will stop what's already unfolding beneath the surface. Because while Washington scrambles to play defense, Beijing is laying its offense. In oil contracts settled in yuan, in cross-border digital rails, in state-backed settlements unmoored from the dollar. So if you think this was the climax of the US-China economic war, you've missed the point. The battlefield isn't in the headlines. It's already moving underground.